Welcome to a pointed, hour-long conversation between Quoth the Raven and Peter Schiff, the gold advocate and longtime Bitcoin skeptic, laying out what the host calls Schiff's blistering case against Michael Saylor and his company, STRC. Schiff has been a bear for decades and has, by his critics' count, called Bitcoin dead many times, so it's worth saying up front what this is. One prominent skeptic's argument, not a forecast to trade on, and the host pushes back on it throughout. But Schiff has also been early before. He was among the first high-profile voices warning about Celsius and Alex Mashinsky before that company collapsed. And here he makes a detailed, numbers-driven argument about the risks he believes are hiding inside STRC's capital structure. What follows lays out his case in full, along with the host's counterpoints, so you can judge the reasoning for yourself. Everything depends on Bitcoin's price. Schiff's starting point is that nearly every debate about STRC collapses into a single assumption, whether Bitcoin keeps going up. If it does, most of the problems he describes simply melt away. The host makes exactly this point, noting that if Bitcoin rallied back toward $150,000 or $200,000, many of Schiff's concerns would disappear. Schiff agrees, and then turns it into the crux of his argument. In his words, if Bitcoin goes way up, Saylor gets out of jail. But relying on perpetual appreciation is precisely the flaw in the bull case. As he put it, the assumption that it's going to go up is irrational relative to the assumption that it's going to go down. The entire edifice, he argues, is a leveraged bet that one volatile asset only ever rises. The death spiral, a virtuous cycle turned vicious. The recurring theme of the conversation is what Schiff describes as a classic financial death spiral. The mechanism is a feedback loop. Lower Bitcoin prices put pressure on STRC. A weaker strategy makes it harder to raise fresh capital. To meet obligations, the company may have to sell Bitcoin. Selling Bitcoin puts further downward pressure on Bitcoin itself, which feeds right back into STRC. Round and round. For years, this loop ran the other way. Rising Bitcoin lifted STRC, which raised more capital to buy more Bitcoin. Schiff's line captures the reversal. The virtuous cycle is now a vicious cycle. The host pushed back that the speed of any such spiral depends entirely on Bitcoin continuing to fall, but Schiff countered that markets don't wait. Once they begin anticipating forced selling, they discount those risks long before they actually materialize. The collapsing Bitcoin yield. Schiff's most concrete evidence is a metric STRC itself invented, Bitcoin yield, which tracks the percentage change in Bitcoin held per diluted share. It is the company's core argument for why owning the stock is better than owning Bitcoin directly, the idea being that its capital markets activity keeps adding Bitcoin per share over time. Schiff's point is that this number is now going the wrong way, fast. As of late May, the year-to-date Bitcoin yield stood at 13.3%. After Saylor's latest capital move, it had fallen to 4.5%, a 66% decline in under 2 months. His blunt conclusion: at this rate, the 2026 Bitcoin yield will turn negative. And when that engine stalls, the whole premium to Bitcoin story starts to look shaky, because the thing that supposedly justified holding the stock over the coin is evaporating. The first big Bitcoin sale. For years the pattern was one-directional. STRC only ever bought. That changed. The company sold 3,588 Bitcoin for roughly $216 million to fund its preferred dividend obligations. Its first significant Bitcoin sale in years. Schiff treats this as a tell. STRC has built up a dollar reserve of around $3 billion, in part to manage the roughly $1.76 billion a year it now owes in preferred stock payments. The company that was designed to be a one-way Bitcoin accumulation machine has started liquidating the very asset it was built to hoard, simply to keep its financing commitments current. The machine now runs in reverse. This is the structural heart of Schiff's argument. The capital structure that was engineered to accumulate Bitcoin, he says, is increasingly being used to service the obligations that accumulation created. Every new preferred stock issuance dilutes the Bitcoin yield a little further, and every Bitcoin sale to fund dividends compounds the problem. What was a flywheel becomes a grinder. The more the company issues to stay afloat, the worse the per-share Bitcoin math gets. The worse that math gets, the harder it is to raise capital on good terms. And the harder that becomes, the more likely it is to sell Bitcoin. Schiff's contention is that this dynamic doesn't require a crash to hurt. it quietly erodes the thesis even in a flat market. Ponzi and fraud, the STRC charge. Schiff does not soften his language. He has called Michael Saylor the biggest fraud on Wall Street, and strategy itself a Ponzi scheme. And in this period, he argued that Saylor crossed the line with the STRC Ponzi scheme, a reference to strategy's preferred instrument carrying a yield around 11.5%. His framing is that paying high fixed yields to one set of investors while relying on continuous new issuance and a rising Bitcoin price to make it all work has the shape of a scheme that depends on ever more capital coming in the door. Whether or not one accepts that characterization, and it is a serious accusation the host did not simply endorse, it is the emotional core of Schiff's blistering case. Just own the asset. There's a simpler conclusion Schiff keeps returning to, and it's aimed even at Bitcoin bulls. If you genuinely believe Bitcoin is going higher, he argues, you're better off just owning the asset directly than holding the stock. The stock's whole selling point was leveraged, compounding exposure, more Bitcoin per share over time. And once the Bitcoin yield collapses towards zero or negative, that advantage inverts into added risk, the debt, the preferred dividends, the dilution, and the forced selling dynamic. In Schiff's telling, shareholders can end up with a negative Bitcoin yield, meaning they're effectively losing Bitcoin exposure per share even as they carry all the corporate risk. Own the thing, he says, not the leveraged wrapper around it. The host's pushback. To the host's credit, this was not a one-sided infomercial. Quoth the Raven repeatedly challenged Schiff, and those objections matter. His central one. Nearly every scenario Schiff outlined depends on Bitcoin continuing lower rather than recovering. If Bitcoin simply rallies, the death spiral never starts. He also questioned the timing, pushing back on any suggestion that strategy's problems are imminent or that a collapse is around the corner. Schiff himself conceded the process could take time and hinges on price. In other words, the bear case is real but conditional. It is a claim about what happens if Bitcoin keeps falling, not a certainty about what will happen. That conditionality is exactly what separates an argument from a prediction. A number, not just a prediction. Which brings us to why this particular round of Schiff versus Saylor drew more attention than the usual sparring. Schiff has been wrong about Bitcoin many times, and skeptics are right to weigh his long track record of bearishness. But the thing he is pointing at this time is not a vibe or a forecast. It's a live data series. A Bitcoin yield that moved 66% in the wrong direction in 2 months, a company selling Bitcoin to pay dividends, and a growing pile of fixed obligations. Bulls counter that a Bitcoin recovery resolves all of it, and they may be right. The honest takeaway from the conversation is that both things can be true at once. Schiff may be early or wrong again, and the underlying numbers are still worth watching. None of this is investment advice. It's one skeptic's argument, laid out in full, for you to stress test yourself.